Hi, welcome back to our lecture on a practical guide to quantitative finance interviews. Today, we are going to enter the second last chapter, finance. We are going to first talk about option basics today. So in quantitative finance, I think derivatives is one of the most important topics that is frequently asked and you should be answered during the interviews, no matter for sell side or buy side. It used to be common for candidates with no finance knowledge to get hired into quantitative finance positions. But although this still happens for candidates with specialized knowledge that is in high demand, for example, deep learning nowadays, or large language models, apply AI, but it's more likely that you are required or at least expected to have a basic grasp of the topics in finance. It's not that you don't need to be that deep into traditional finance, like doing fundamental analysis or to know how to make financial statements, but you should expect to track the market, know the basics about the derivatives, and besides classic textbooks, there are also some few interview books in the market to help you prepare for finance interviews. For example, this green book, right? But if you want to get prepared for general finance problems, I think there are two things that is important. One is go through this chapter with me to understand what types of questions you are expected to be asked. The second thing is to book a Financial Times or Washington News Journal to try to follow the market, knowing what is happening now in US market, in China market, in the market if you want to seek your job, a position. Okay, so now let's start. As what we always did, so we are going to first have a chapter overview. So for this finance chapter, basically you can see it's all related with the derivatives. It has a strong emphasis on option pricing and also the Greeks, which is also related with option and some quite classic quant strategies like data hedge or gamma scalping. And we're also going to tap a little bit on portfolio and exotics. You know, for a lot of big banks like Goldman, Morgan Stanley, they all have a group under their structured product, which is called exotics. And we're also going to cover some few other finance questions that is frequently asked, like interest rate or forward and futures. Again, it's just a walkthrough. So if you are targeting certain companies which is specialized in certain scopes, for example, PIMCO for FICC, then of course you need to find more questions by yourself. Okay, so now let's start. Let's first clarify certain notations that we are going to use during this whole chapter. I'm going to be aligned with the green book, which is also basically the industry default settings. The first one is the maturity, we should denote it with the big T. It means the end day, the last day of the option, okay? And T, the small t, is the current time, basically today. And so we have tau, this is denoted as this, tau, which is just the gap between the large T and small t, which is the time to maturity. And we denote as that stock price time T as T. And we also have the continuous risk-free interest rate, which is R. And you need to know the current risk-free rate right now. It's the short-term US yield bond, which is currently around 5.5. You know, it has been a lot of riding this year. And we have Y, which is a continuous dividend rate, depend on the company or the stock. If you are buying things like futures, of course, you don't have any debt. And you also have sigma, which is the annualized asset volatility. And the small c is the price of the European call, and P is the price of the European put. A large C is American call because, you know, it's invented by Americans. So American first, they got the capital letter, okay? And they also have a large P. And we have the D, the present value, which is why it is called because it's also the discounted value of some future cash flows, right? And we also have K, which is the strike price of an option, and present value is just the PV, okay? This is the present value of future dividend because dividend is our cash flows in the future. So that's it. I hope you remember that. And I think you are going to get familiar with this group of settings in the questions below. So let's first know what is option. Option, again, just like its name, right? You got an option, you got a right to execute it to buy or sell certain amount of asset at a certain time with a certain price. But you can do that, but you also have the right to not execute it. So it basically you are buying a right. You are not buying the asset directly. So let's see the first graph. Basically, we have two kinds of options, which is call, which is put. Call is basically the same like long the position, and put is basically like the short position if I'm buying a call, okay, or buying a put. And of course, if I'm selling a call, then it will become a short position. So for a long call, basically we have a strike price K here. And if the stock price ST at the maturity is larger than K, then I'm going to earn this amount of money. This is my profit. But again, if it is smaller than this amount of money, I can choose to not execute it. And I only need to pay the option price, which is the cost for me to hold this right? And if I long a put again, it's just another situation. Or if ST at maturity is smaller than K, then I'm going to win this amount. And if it got a large jump, it increased to a next level, then of course I will not choose to execute it, and then I'm going to lose option price, which is P or P. This is C or C, right? And if short call, basically we are just trying to flip this this line around the x-axis, and it's also the same for the short put situation. Okay, and you can also construct portfolios by putting call and put together. For example, long a call while shorting a put to construct a certain portfolio. I'm going to talking about that in later chapters when we're talking about Greeks and option portfolios. Okay, and one important thing to know is that the price direction of options. You need to know how the price of the option is going to change according to the stock price ST, the strike price K, the time to maturity, tau, volatility, sigma, risk-free rate, R, and dividend, Y. Okay, let's talk about it one by one. So first, if it is a call, then of course, if the stock price goes higher, I'm going to get more profit, right, according to the plot here. So basically, the value is going to increase. You can see from here. And if it is put, I earn money by having a lower stock price. So of course, if the stock price goes up, it is going to be valued less. Okay, so basically for all call, it rise up, no matter if it's European or not or American. But for put, it all goes down. Okay. But for strike price, it is another case. Because if my strike price is higher, it means it becomes more difficult for me to get a profit from the increase. For example, if my current strike price is 60, then current stock price is 62. If my strike price is 60, I already earn $2, right? If I'm long European call. But if my strike price is 70, of course, I currently still cannot execute it, which makes that if the strike price goes higher, the cost value is going to be lower. But for put, it is another case, right? Only a lower strike price makes the execution more difficult. Okay, so basically these two are just different with each other. Okay, but how about time maturity? So for a European call, it really depends. Why it is the case? Because, for example, if there is a large dividend payoff, okay, let me write it here. Large dividend payoff between a maturity 1 and maturity to day 2. Then with the short maturity before the exit dividend day, it could be worth more if it is a call. Because if it is call and I execute it at T1, then I can get the dividend during T1 to T2, right? But if I can only execute the option at T2, then I have no chance to get this amount of dividend. So it is not sure. But for American, since we can execute the option at any time I want, so with longer time to maturity, the value all goes up. Why it is the case? Because it bears more right for you to counter any risk. If I have an option to execute a stock at let's say $100, if it is a call American call option for the next 100, it is going to be valued at a huge amount. Okay, because no one is going to know what is going to happen in the next 100 years. But you have a certainty that you can execute as long as the price of this stock goes to higher than 100. Okay, that's a huge benefit for you. And now let's for volatility. So for volatility, I think it's really important to emphasize this. You can see what all the 4 arrows goes up. It means what? As long as you hold a long position of an option, no matter it's a call or a put, and you got benefits from volatility. When we talk about Greeks, you are going to know this is called Vega. Okay, basically, if you long any option, you are trying to buy volatility. You are betting that volatility is going to be high. Why it is the case? Philosophically speaking, if you really think about why we should have an option in the first place instead of directly buying that asset, is because of the uncertainty of the future. If I'm 100% sure that the price is going to go up in the next month, then why do I need to spend extra money to buy a right, to buy an option? I can just create a long position on that stock, right? Instead of paying extra $1 or $2 to hold an option. But it is because I also know that there could be 1% or 20% probability, that percentage chance that the price will go down. Then I'm going to buy an option. Since even if it go down, I'm not going to lose that much. I'm just going to lose the cost of this option, right? So basically, buying option is buying volatility, and option is just almost the same as volatility to some extent. Okay, it's quite intuitive, and I hope you remember that. And then how about the risk-free rate? For risk-free rate, it has nothing to do with option. You just need to remember for all call, it goes up, and for all put, it goes down. The thing is that because it's just like creating a long position and a short position. When we create a short position on a stock, basically we are trying to borrowing money, right? I'm going to pay some interest at the end of this short position. So if the interest rate goes higher, it means the cost of borrowing money also goes higher, right? So my cost increase, of course, the value is going to decrease for put, okay? And then for dividend, if the dividend increase, then the call is going to decrease because I'm not holding this option during this period. But for put, it increased just like the same logic we talked about right, for the time maturity, because if I'm buying a put, then I'm always holding that, okay? I'm always holding a chance because it's just like the same to create a short position. You are borrowing this stock to short it first. And then for any dividend paying, it is going to increase your chance of earning money, okay? And next, let's talk about put-call parity. So put-call parity, as shown here, it's a quite important equation in the whole option world. It tells you that basically put is a call and call is a put. if you really go to the industry, if you go to the Wall Street, you are asking a trader how many option positions he has. He probably won't say something like, I got 300 put option position, long put position, and 200 call position. Instead, he's going to tell you, I got 500 option position. Okay, because put and call is just the same thing. As long as they have the same underlying security, the same maturity, and the same strike price, or whatever, as long as you have the same underlying security, you can convert a put to a call by this equation. Okay. For American positions, the equation no longer holds, but it becomes an inequality because of the special rights that you can execute it beforehand. Okay. So basically, it is just like the call price plus the dividend ratio of the discounted cash flow of the strike price will be equal to the put value plus the stop price minus the dividend pay. Okay. So basically for the left-hand side, I can consider it as a portfolio A, which is just a call option plus a what? A 0 coupon bond with face value K. And the right-hand side as a portfolio B, which is just a put plus the underlying stock and if you can't calculate the expected payoff of portfolio A and portfolio B, both the left-hand side and the right-hand side is going to be equal to max STK at maturity time T, okay? Because for the left-hand side, this is going to be max ST minus K, 0 plus K, right? And for the right-hand side, this is going to be max K minus ST, 0 plus what? Plus ST. Okay, so both becomes this one. And both sides should be equal. And why we have the dividend here? So for dividend, remember before I talked about why we have a higher price for put and a lower price for call when we have an increasing dividend. Because once a company issues a dividend, the stock price is going to be expected to decrease by the same amount of the issued dividends at the X issuing day, okay? And that is the case, we need to consider the impact of the dividend. Do not forget that. And it is calculated on the put side, okay? Because this value is going to be less than this amount. And now let's compare the American and the European options. So the first question is that since American options can be exercised at any time before maturity, they are often more valuable than European options with the same characteristics. But when the stock pays no dividend, the theoretical price for an American call and European call should be the same since it is never optimal to exercise the American call. So why should you never exercise an American call on a non-dividend paying stock before maturity? And this is a quite strong statement. And that's why it is frequently asked during the interview. Why it is the case? Because if I exercise the call option, one of the intuitive way to explain that is that once I exercise it, I will only get the intrinsic value, okay, the intrinsic value of a call, which is S minus K. But the point is, in the real market, the price also contains time value. which is positive for call and negative for put. And this value is actually going to decrease along with the time, as long as you are holding a positive position. It is also positive for put, okay? Because it's related with that we are trying to, because when the time goes to maturity, the amount of uncertainty lies in the market becomes less, right? It becomes more and more predictable for the price at the maturity date. Okay, so the time value is going to decrease along the time. And if you execute it, you are basically missing amount of time value. And that's why it is better to sell the option before maturity date than execute it. Okay. Because if you sell it, you are content, this is the price and you are getting P. But if you execute it, you only get the intrinsic value. Okay, these two are different, sell and execute. And the second way to explain that is that by the put-call parity we just learned. If we rearrange it, we can see call is equal to what? Call is going to be equal to S plus P minus K negative RT minus dividend. And if it is a zero dividend thing, we can just do not consider that because we are just talking about the general case. And you can see that this is the value of the European call on the non-dividend paying stocks. It actually includes the three components. And if we're trying to rearrange it, it becomes what? It becomes S minus K plus K minus K negative RT plus P. So this first part is the intrinsic value. And the second part is the time value of the strike, right? The time value. If you exercise now, you pay K now instead of K at the maturity date. And you know, you pay K now is actually more valuable. This K amount at this moment is more valuable than the K amount in the next moment because we assume there could be inflation. There is a time value of any cash flow, okay? Because of present value concept. And the second is the value of a put, which is just a protection position. And see clearly this and this are both positive, right? Larger than or equal to 0. So it should be a European call should be worth more than this intrinsic value. And this part basically is the time value, right? So that means American call is worth at least as much as a European call. And it is not optimal to exercise the American call before maturity. And there is also another way to think this question, is that you can construct this kind of American call using some strategies. For example, we can exercise a call option at a time smaller than T and receive cash S minus K. And alternatively, we can keep the call and then short the underlying stock and lend K dollars with interest rate R. And then from the short sale, and at maturity T, we are going to exercise a call if it is in the money and close the short position and close the lending. And you are going to see that by mimicking this kind of early execution, we are going to earn just the same or less than amount, okay? And last but not least, I'm going to introduce the last way, which is the mathematical way, which is relying on risk neutral assumption, okay? Of course, it is risk neutral. What is risk neutral? It means that the present value can be evaluated at price T discounted by the continuous interest rate. Okay, it is risk neutral. And we are going to talking about first introduce the Jason's inequality. What is Jason's inequality? It means if fx is convex. Okay, I'm not going to talking about if it's true or all because it's quite misleading. I know there are two definitions of that and they are inverse, they are conflicts with each other. So convex in English is just a function looks like this. Okay, looks like this. And concave is something looks like this. Okay, which means this has larger than 0 and this should be smaller than 0. Okay. So for convex function, I'm also going to recommend you a good way to remember these two. So concave, it has a word cave, right? You know, for a 洞穴, it has a door like that. You know, this is dark. So for concave, it looks in this way. So convex is something looks like that. Okay. So Jason's equality is going to tell us that if fx is a convex function, then expected value of fx is going to be larger or equal to the function of the expected value of this f. Okay, and if a function is convex, we can also have another inequality, which is, let me write it here, which we are going to have the function of lambda x plus 1 minus lambda y shall be less than or equal to lambda fx plus 1 minus lambda fy. For lambda smaller than 1 and larger than 0. Okay, so these two equations inequalities you should memorize. And how can we prove that American option cannot be exercised earlier by these two inequalities? Well, it's quite easy. So we can just replace this y as s1, x as s1 and y as s2. So basically, let's s1 equal to s and s2 equal to 0. We are going to have what? F lambda s should be smaller than equal to lambda f s, right? And by using the expectation, we can also have the expectation of this fs t discounted at this period is going to be larger than or equal to the discounted rate, the function expected of st, which is just what? Which is just ERT ST, okay? The smaller than t. And we know this is going, the left-hand side is going to be E negative R tau expected value of FST, right? And we cancel these two parts. We can have that the expected value of F at maturity is going to be larger than equal to FERT for any t smaller than the maturity date, right? Which means the value of this American option at maturity, the expectation of this value of the price of this American option is going to be its maximum than any time period before that, okay, by Jason's inequality. And I think it's really a good way to prove that it's elegant, okay? So now let's see the B part. A European put option non-dividend paying stock with strike price 80 is currently priced at 8, and the put option on the same stock with strike price 90 is priced at 9. Is that an arbitrage opportunity existing in these two options? Well, again, we can use the convex property, right? Since we know a put option with strike price 0 is going to be useless, P0 is definitely going to be 0. And then we can have what? We know it's a convex option. So we can have the lambda pk larger than or equal to p lambda k. Since the payoff of an option is always a convex thing, okay? Because for a put option, why it is also convex, you may asking this question, because for a call option, it looks like this. So the payoff is generally smoothing like this. It is convex. For a put, again, it looks in this way. So again, if we smooth it, it is still convex. So basically, if you long any option, you are going to, the payoff is going to be a convex function, okay? And now we still hold this inequality. Then what we need to do is just to put in the values. Okay, we can have P90 if we use lambda 8/9, it's going to be larger than or equal to probability 8/9 multiplied by 90, which is just probability 80. Okay. But however, we can see what? We can see currently a European put option with strike price 80 is priced at 8, right? And this is priced at 9. So these two are equal. And the price of this strike price 80 is overpriced, because this should be strictly larger. Why we do not have the equal here? The thing is that the thing is that if the equality needs to be whole, the k needs to be 0. Okay, but this k is not 0, so we can just replace it with the strictly less than value. Okay. So we know there is the option with the strike price 80 is actually overpriced. And if something is overpriced, how can we do that? Basically, we can short that, right? And how can we short that? We can construct an arbitrage portfolio to short 9 hands of put 80, okay? And then long 8 hands of put 90. And actually, you can calculate it that you are going to find that if, okay, the situation A, if ST is larger than or equal to 90, then we are going to get what? The payoff is 0, right? The payoff is 0. because none option is executed. But in the second situation, if ST is smaller than 90 and larger than or greater than 80, then the 90 is going to be executed. So basically, we are going to earn 90 minus ST multiplied by 8, which is larger than 0. And for situation C, if ST is smaller than 80, then what are we going to learn? We're going to earn 8 multiplied by 90 minus ST minus 9 80 minus ST, right? And we can see these two parts cancels out, and we are going to have 1 ST, which is larger than 0. And so there is clearly an arbitrage opportunity. Okay. And basically that's all for the option basic lecture. I hope you have a basic understanding about the call and the put option, the difference between the European and the American option. And next lecture, we are going to combine the Ito's lemma, the partial differential equation, and also the option we just learned to talking about, I think is one of the most important formulas for any quantitative analyst, which is the Black-Schoen model differential equation and the Black-Schoen model. Okay, so see you next time and prepare for that. Bye.